This is another buying opportunity in our view. 2024 has proven to be a year where the market's been strong and it has eluded many opportunities for sustained weakness. I know yesterday's pullback was really painful, but to us, I think the fundamental supporting stocks are intact, and I think it's a good opportunity for investors here.
A good opportunity for investors. Jeff, I take it that you feel is differently putting it too strong?
Well, I don't disagree with Tom on the fundamental side of it, but I think if you look at where we're at with the interest rates, what's on the horizon from taxes, tariffs, and deficits, I really have to be considerate of what happened yesterday. It was the second largest move in the VIX we have seen. And historically speaking, Kelly, Tom is right. A month after that spike in the VIX, you see the S&P 500 higher. However, I don't think we can lean on history here due to the fact that we've seen stretched valuations in the top 10 names of the S&P 500. We've also seen just a straight line up. If you look in the last 2 years, back-to-back years of above 25%, we've become conditioned that the market's just going to continue to move higher, thanks by and large to the Fed dovishness in their $7 trillion balance sheet. So I'm looking, I know Tom wants to back up the truck here. I have the truck running, but I'm not ready to back it up yet. I want to see this more process, reset valuations. I think that's going to be the next couple months, possibly the first quarter, because we've become too conditioned, Kelly, to markets repricing in a day. I have to go back to my 30-year career and understand that we will see reset valuations more of a quarter or two, not just a day or two.
You know, Tom, this has been a bit of a slide for the Dow, to put it mildly. We had 10 down days in a row. You say you saw signs of capitulation yesterday, as it was a 90% down day.
I did, Tyler. You know, as context, the market has been bleeding lower. If you look at internals for the last 10 days, yesterday looks capitulatory because not only did we have a 90% down day, but the VIX, the spot VIX, exploded by 75%. There's only 4 times in history where it's risen 60% in a day. So yesterday was the 5th time in its 35-year history. Of those 4 times, the market recovered all of its losses within a week, 3 out of the 4 times. The 4th time it took a month. So I think what you had was people panicking to get out of what they thought was a momentum trade that's ending because we're so close to year end. But here's the interesting thing. The forward VIX futures curve barely moved. So it was almost as if people were seeking protection through the VIX yesterday.
What tells you, Jeff, that more valuation resetting is to come?
I think due to the fact that we only had 1 down day, Ty, typically when you see prices reset or revalue, you have consecutive down days, and those consecutive down days bring along margin calls. And you saw Interactive Brokers head talk about his concern of margin being used on the Mag 7. So when I look at a day like today where you're seeing passive indexes buoy the overall 3 major indices, NVIDIA, Facebook, these names are coming back because you're seeing people deploy cash in a passive index. So I do get concerned about that short-term volatility, but I'm going to embrace this volatility over the next month or two because I don't think history is going to line up. This is not going to be the same way. We've seen a straight-up move ever since last November, and especially since November 5th after the election results. So I do have concerns short-term, but I am cautiously optimistic at 2025. But there's going to be more volatility. This was like a depth charge that went underneath the water. There will be ripple effects.
Tom, let's talk about the small caps for a minute, because they have these kind of moments where they look really promising, they go on a tear, and then it just stalls out. And a lot of investors are feeling frustrated and wonder if it's worth sticking around.
Yeah, I mean, I'd say investors are tired of having like the rug pull on small caps. Yesterday's an example. Unfortunately, when markets get nervous and they're risk off, and of course buyers disappear, stocks that aren't as liquid get hit harder. That's why the Russell not only has been sort of under pressure for a couple of weeks, but really got hit yesterday. But do we think anything has undermined what makes small caps attractive the next 5 years? It's still in place. I mean, they've underperformed the last 10 years by the second largest magnitude in the last 125 years, except for 1998. So not only are they derated, but now we have a roadmap of deregulation, possible mergers, at a time when financials, which is a huge weight in small caps, look more promising, and things like biotech, which is a huge weight, also look more promising with deal activity. So I actually think this is, again, another chance to buy a dip.
Let me ask both of you to respond to this idea, and that is that did the chair yesterday effectively or tacitly concede that maybe they moved too fast too soon? In other words, by cutting 50 in September, again in November, again. What do you think, Tom? And then Jeff, your thought?
Fed fund futures were only pricing in 2 cuts essentially next year, depending on how you wanted to look at the level of Fed fund futures, and the Fed essentially agreed with that.
Essentially agreed.
Yeah. So the Fed sort of forecasts just were not what the market was expecting. I don't think the market expectation is wrong. I think it's better for the Fed to be wanting to support the economy. So in other words, get to neutral. But the fewer cuts they do in 2025 actually is better for this bull market because it provides a lot of future ammunition to protect the economy. So to me, the idea of going from committed 4 cuts to 2, or potentially 4 to 2, and maybe even only 1 cut next year, I think that's actually a bullish outcome.
Jeff?
It felt like a confessional yesterday because Fed chairman, he actually came out and said that their forecast for inflation really fell apart towards the end of the year. So I believe that they had to kind of catch up with the 2-year note. And I go back to my career where I started in the U.S. Treasury pits in Chicago, the Chicago Board of Trade. The bond market has always provided leadership. But what's interesting now, I think the 10-year can go to 5% before it goes back to 4%. And with the way inflation is trajectory and moving higher, the Fed has seemingly moved away from their 2% target. Because if you think about it, Ty, the Fed would have to have CPI go down to 1% for about a year or 2 to get anywhere near those 2019 pre-COVID levels. So I think the Fed may actually have to hike rates before they cut them again. I know that's a bold statement, but it may actually happen in Q2 or Q3.
Well, we will see what happens. Tom Lee, thank you very much. Jeff, you're going to stick around for just a minute because today, thank you, Tom.